welcome. I'm Stephen Vakovich, Managing Director of Educational Programs at Chi Association. Delighted to be joined today by Aaron Vale. Aaron, why don't we start off with a just quick introduction, give everyone a sense as to who you are.
Thank you, Steve. Aaron Vale, Global Managing Director with MIP, which stands for Mexico Infrastructure Partners, and proud Kaya member.
Excellent. Well, thanks so much for joining us today. As folks might guess, we're going to spend the time talking about infrastructure. For everyone's reference, Aaron, such a great supporter, helped out with this infrastructure micro-credential that we've launched. You helped co-author it. A lot of insight and resources for us as we put it together. So a lot of smarts, expertise here when it comes to infrastructure, and delighted to be able to benefit from the insights in this conversation. So let's start at the beginning. Why did infrastructure stand out to you from a career standpoint? What caused you to pursue infrastructure versus any other kind of alts or real asset area?
Yeah, absolutely. Well, I've always been interested in business and investing, and I remember a vivid guest lecturer in my final year at McGill University. I was taking a real estate finance course, and we had an expert from SNC Lavalin come in to discuss their investment in the 407 ETR, which is one of these marquee trophy toll road assets in Ontario and very close to home, literally for me, as I grew up in the 905 region where the 407 traversed. And I remember him describing the opportunity, how it came about, what the equity perspective was for this privatization, and I was captivated, particularly around all the zeros in the enterprise value. We were talking billions and billions of dollars. And I thought, wow, that's pretty cool. And was super lucky early in my career to get a big break with the godfather of infrastructure investing, Macquarie Bank, an Australian investment bank who really pioneered the asset class as we now know it and is still one of the largest managers. So joining in quite interesting times, October, September 2007, I was on the toll road team and actually got the opportunity to be an investment analyst for Macquarie's ownership in 407 ETR, Chicago Skyway, Indiana Toll Road, a bridge in Montreal. And what captivated me was how complex and nuanced these investments were. So many different stakeholders, risks, contractual overlays, debt, equity, asset management. I was hooked. And right in the heart of the GFC, March 2009, I was offered an opportunity to move to Mexico City with Macquarie to launch an infrastructure fund business there. And that just accelerated my interest in the global opportunity set, moving to a new culture, a new regime, a new opportunity, but still rooted in this infrastructure asset class. And after a couple more journeys around the world, I did an INSEAD Master of Finance that Macquarie sponsored. I moved to Calgary to do oil and gas investment. I did a startup with kind of people I met in Mexico at MIP now. I just found this asset class had so much to offer in terms of the opportunity set that was growing dramatically at the time and hasn't stopped growing, the complexity and the nuance involved in diligencing or acquiring an asset. You're looking at 12, 18, 24-month underwriting processes, the long duration perspective an investor needs to have, where you can be underwriting a transaction on a time frame of 10, 15, 30, 50-year horizons, and triangulating so many disparate different sources of information, very idiosyncratic, to form a view of what is a good investment or not. And it took me about 10 years in this journey to realize, wow, I've developed a little bit of a network of people that are doing this around the world. And that's when I knew, this was going to be my professional journey and destiny. And I haven't looked back since.
Well, that's such a great story. I mean, you touched on so many different things there. That there's so much growth happening in the marketplace. The complexity is there. And the thing that kind of stands out to me from the beginning of your story is you talked about toll roads. And for most folks, if you started off with, I got into toll roads, their eyes would probably glaze over or they'd say, how boring could that be? But you articulated really well how complex and interesting it was of an experience for you that really drew you in. And I think that might be something that is underappreciated in infrastructure is that it's not this boring thing necessarily.
No, anything but you reminded me of my family glossing over at the dinner table when I would come home talking about toll roads. But they can be cool. The 407 ETR was the first highway globally to have no toll booths, no cash. It's called ETR because it was electronic toll road. And to support an electronic toll collection, you had a control room of 60 cameras looking at license plates. If they didn't have a transponder, figuring out a billing process, and never one to doubt the innovation of people. There were all these tricks drivers, truckers would use to try to evade getting tolled. From pressing a button to covering their license plate to changing a 6 to an 8. And you found in each one of these investments, these opportunities, these nuances that connected on a human level.
So, kind of pivoting a little bit then to investment portfolios, one of the things that we can see sitting at a global perspective is that there are some markets that have really embraced investing in infrastructure and you see meaningful allocations in portfolios, whereas there's other geographies where infrastructure is minimal and is still quite nascent from it, even at an institutional investing level. So I'm wondering if you could just sort of speak to why might there be some markets that just haven't yet gravitated towards infrastructure as a relevant or meaningful portion of their allocation to alternative investments, which could be quite large overall.
Yeah, it's a great question. And one that I rationalize looking at the history of this asset class evolution. We think about real estate as one of the oldest asset classes, private equity from the 70s and the 80s really taking off. Infrastructure really didn't emerge as a unique asset class until the early mid 90s in Australia with Macquarie, where the Capital Decanted podcast on infrastructure did a great job of describing this confluence of three factors that allowed this asset class to emerge in Australia. One, the government was in trouble. Fiscal debt imbalances, budget shortfalls. Historically, governments who have been the largest provider of infrastructure development, they didn't have the money. So that was one factor. A second factor, you had these superannuation plans, pension plans in Australia, growing, emerging, capital to invest, looking for opportunities that could fit their fiduciary obligations to provide income, inflation protection for their beneficiaries over the long term. And then the third factor is you had this financial investment banking ecosystem with Macquarie and others who were able to connect the government shortfall for projects with the investors who wanted to fund these projects to really start developing this asset class. So, not surprisingly, Australia is one of the largest investors in infrastructure. If you look at the pension plans, the superannuation plans there, you'll see very high allocations. Then Macquarie decided, let's take this model to Canada. So in 1998, they created their first non Australian fund and pitched it to some of the large Canadian pensions who bought in. And that really springboarded the Canadian opportunity set developing, where we had projects, we had pensions that wanted to fund projects, and we had a bunch of bankers, Macquarie and others, that started to connect the dots. So unsurprisingly, you see Canada with a huge investment in infrastructure. Macquarie quickly moved to Europe, and Europe had a lot of privatization opportunities from Thatcher and just an environment that was comfortable with privatized toll roads, privatized airport, privatized regulated utilities. They had emerging investor pools in the UK and Europe. And boom, now you see Europeans having huge allocations. Now you might be wondering, well, what about the US? The biggest capital markets, the biggest investor pool. Why is it lagging? Well, the first sequence of investment into infrastructure institutionally happened in that mid 90s, early 2000s, right up until the GFC. Unsurprisingly, Citibank, Morgan Stanley, Goldman Sachs, they saw what these Australians, Macquarie, were doing and said, why don't we create our own funds? And in the mid early 2000s, you saw a whole bunch of new funds being created from these global investment banks, from other groups to start tapping into US capital pools. The GFC put a thaw on investment evolution, but post GFC, we saw even more new entrants coming into the space. Groups like Brookfield, KKR, GIP, some of the brand names that now people think of when they identify infrastructure as an opportunity, they didn't start investing in infrastructure until 2010 onwards. And that takes us to where we are now, where those incumbents have grown, new entrants have emerged, the asset class has continued to deliver, and we see more and more adoption. The US in particular, though, is still a laggard on global scale. And I wonder, as others do, is that changing or what has caused that kind of lack of adoption? I think there's a couple observations I would make. One is the US pension fund scheme, the state pensions, they have started acknowledging, identifying the infrastructure opportunity and have been big investors over the last 15, 20 years. So if you look at the percentage allocation to infrastructure, you'll always see the big states who have programs and have continued to grow them. Other pools in the US, though, have resisted infrastructure. And I'm going to point to three reasons why I think that's happened. One, some plans are underfunded, have budget shortfalls, are looking for higher return exposure. So when someone pitched them on this great asset class that's going to deliver 10% net return, they go, yeah, I'm going to stick to private equity. I'm going to stick to hedge funds. I actually need higher risk, higher return opportunities. So it didn't fit. Another obstacle that the US market and other investors have faced in confronting the infrastructure opportunity is nomenclature, bucketing. Where does this fit? Is it real estate? Is it private equity? Is it real assets? Well, yes, it has attributes of all of those, but it's also distinct in terms of its cash flow profile and what it can provide to a portfolio. But I think that bucketing and expertise required to underwrite has been a constraint. Finally, infrastructure is very political. It's very local. And I've heard investors say, I don't want to invest in infrastructure because the governor or the mayor where I reside is going to say, fantastic. Now that you're investing in infrastructure, I got a bridge for you to build. And we can dismiss that concern, but it's real. So these factors, I think, are changing. I think infrastructure has proven itself over that long enough period, but the US is still underallocated, and a huge source of growth over the coming years is going to be just meeting other markets' allocations to the asset class.
I want to pick up on a thread there, which is the notion of, quote unquote, what is infrastructure or how does it fit? And you might hear folks say, well, I've got real estate in my portfolio, or I've got core real estate in my portfolio. I'm getting income from that. I'm getting the lower risk return. Why do I need infrastructure? Is it going to be duplicative? It's a real asset as well. So how do you think about that type of commentary?
Yeah, it's a fair commentary, and it requires nuance to unpack. The difference simplistically between real estate and infrastructure are one, real estate is not as idiosyncratic. It's not as unique. When you think about a type A office building or industrial park, you've got hundreds, thousands of precedents, comparables, benchmarks. There's only one airport in the city. There's only one water utility. And that lack of comparison and the idiosyncratic underwriting required for each and every infrastructure asset just differentiates it from real estate. Furthermore, my experience with real estate investors is they're not operators. They like to have the box, they have to have the lease, they like to have operating kind of managers or contractors to manage it. Infrastructure owns the operating company or owns the operations implicit in its business. We have fully functioning boards, business plans, value creations, some of which could be similar to real estate in terms of a lease or a long term contract on revenue. But there's also types of infrastructure that are just demand based. How many people are riding on my road? How many people are flying through my airport? Or regulated. Hey, this water utility, electricity transmission business is so essential. The government's actually going to tell you how much profit you can make over a 5-10 year period. And that's what we call kind of a regulated asset based model. You don't have that in real estate. Those types of different revenue structures, I think, also differentiate it a little from real estate. But one of the first tests we look for in infrastructure is location, is catchment, is people. So there are a lot of similarities, overlaps in the circular Venn diagrams. But I like to quote one of an infrastructure founder who describes the asset class as, it's hard to define, but I know it when I see it.
Excellent. So for those who are looking to get exposure to infrastructure, they understand the story. And the logical next question would be, I appreciate that I might be able to get exposure to infrastructure through public markets or through private markets. Setting aside the whole volatility, price smoothing type of a conversation, which is a different kettle of fish, as they say, what kind of difference is there in terms of the exposure, experience, whatever you want to call it, in terms of your decision between public infrastructure investing and private infrastructure markets?
Yeah, it's always a question of debate and one that there's no consensus. My view, having seen allocators, managers access the asset class, is there's a role for both. And specifically, if you came to me, Steve, and said, I want exposure to US utilities because they are going to be the best access point for the growth in generation load to service the data center growth we are seeing due to AI and the consumption of data, you're going to have a hard time accessing that privately. But you'll have no trouble accessing that in public markets. And we see that in different regions, different sectors, that trophy assets, marquee assets, unique exposures that you might want are better accessed in the public markets. Likewise, on the private side, if you want exposure to a specific sector, a specific region, a specific size, or a specific stage of development, you might access those better on the private side. We can gloss over the volatility because I don't want to be too controversial here, but investors do like the smoothing. But I think even more critically, when you have a private asset, you don't have to worry quarter to quarter. You don't have to worry about beta effects. You can take a 5, 10, 15-year view of board, governance, business plan, management team, growth that might be more difficult in the public markets. And we've done a lot of analysis and studies over the return profile. Over long enough periods, you find the returns are more or less the same. But we don't have a private market investable ETF index to access infrastructure. There is a selection risk implicit in how an investor will build out their infrastructure program from privates. Versus in the publics, you could get any number of ETFs, indices, that do cover, a lot of public infrastructure exposure. So it really depends on what you're looking to achieve, over what duration, risk, return, and a whole host of other factors. But I don't think the answer is either or. I think it's both. All that being said, similar to other asset classes, we are seeing privates eating public's lunch. So when I started in this industry, private infrastructure was raising 10, $20 billion dollars a year in third party assets under management. Now we're up to 150, $200 billion dollars a year. And the growth is compounding. We have not seen the same growth in flows in public infrastructure. Furthermore, we're seeing a lot of publics taken private, and we're not necessarily seeing the privates go back to public. Now we're seeing them stay private. When an institutional investor acquires a trophy asset, it might never hit the market again. So a lot of complexity there, but I do think for a lot of investors, especially with now the latest growth in evergreens, semi-liquids, though I know I'm not allowed to say that, especially for an illiquid asset class like infrastructure, there should be some thought at an individual or investor level before jumping into the privates. Hey, can I achieve some of the same objectives on the public side?
So, one last thing I want to touch on. First off, I learned so much about infrastructure building this program, and gained a lot of knowledge from talking with you and working with you on this. And one of the things I realized is I had a bit of a misconception about infrastructure, in that I had in my head bucketed it as this very, very low risk, very income heavy return profile, and that it was not well suited for investors who are seeking a higher return. But as I went through and explored, I understood that infrastructure, it has multiple risk return options available to it. There's opportunistic infrastructure and value add infrastructure, just in the same nomenclature we use in real estate. So my question for you is, you obviously talk with a lot of folks. Is there a singular or most common misconception about infrastructure that you encounter that would be worth discussing?
Well, let me dig deeper into your misconception, which is spot on, and also a sign of the evolution of the asset class. My pet peeve historically that I've learned to stomach is IRR. And IRR, as the single most important, all encompassing return metric that drives our asset class and other asset classes, is a pretty meaningless number. Why? Because it assumes you can reinvest cash flows at the same return. It's not comparing to any opportunity cost of capital. It's just calculated from a set of cash flows. I can show you different sets of cash flows with meaningfully different IRRs, so you can game that number. But especially for a long duration asset class like infrastructure, you see a lot of confusion around IRR. And what do I mean by that? Well, suppose two managers came to you and said, I am going to invest in renewable energy in Estonia. I'm getting a government contract to buy my electricity. I have the equipment. I have the land. I have the interconnect. I have the permitting. I got the management team. We are going to hold these assets 30 years. Sounds like a pretty common pitch to an investor. Fast forward 5 years. Both managers have executed. One takes the decision to sell it to someone who wants to hold it for the next 30 plus years. And doing that, they're going to capture all that legwork to take an idea into a project delivering cash flows, probably benefit from a lower risk premium attached to the operating asset versus when they came in. And the net effect is going to be, a pretty good IRR. Now let's go back to our first manager. They sold the investor a 30-year cash flow. They're going to hold the asset, and the asset ends up performing beautifully. You're going to see the IRR for that second project much lower. Time kills compounding and IRR. So if I look at the 5-year 15% IRR and the 30-year 10%, is one better than the other? No. They just chose to capitalize on the opportunity indifferently. And I see this a lot. So when I'm looking at returns, I'm thinking about IRR, yield, MOIC. That's kind of and if you want to add some nuance, leverage, as some of the key variables to really understand a track record or returns. And just equating to one is you're missing the picture and some of the permutations available to very smart managers who are aligned to boost that IRR as much as possible to get kind of their carried interest and keep on raising capital from investors. Yield is a good thing. It takes cash off the table, gives it to investors, de-risks an investment proposition along the way. Now, one manager could choose to pay out the yield. Another manager could choose to reinvest it. Is one better than the other? Well, the reinvestor probably will get a higher IRR. But that depends on kind of the strategy and what they're pitching to the investor. So I think that misconception can come up, and it really requires understanding, the strategy, the duration, the leverage, the yield profile to really ascertain kind of performance.
Well, Aaron, thank you so much for the time today. This was great. I learned a ton as expected. Really appreciate all the help and support and insight, and keep on keeping on.
Yeah, I'd love to. And maybe a final word for those skeptics. Investors that are in the asset class keep growing their allocations. New entrants into the asset class are clamoring to get exposure. So something must be working. And I think what it is that's working is, whether it's the GFC or COVID or Euro crisis or supply chain shocks, our societies, our communities, our countries always need to invest in their existing infrastructure, new infrastructure. So it's always active, it's always available. Intuitively, you and I understand it like everyone else. How am I going to heat, drink water, get around, be on the line? So these essential assets have a diversifying non-correlation impact that investors in the space or new investors are trying to access. And furthermore, it's just, as we started, very intellectually stimulating to think about why are data centers growing so much in the US, but not as much in another region? Why can I invest in airports in Europe, but can't do it in the US? So I think you'll just see it growth more and more and more, and hopefully it continues to deliver.
That's such a great point to end on. Thanks again. Appreciate it, and we'll talk some more down the road, I'm sure.
Thank you, Steve.